Welcome to the Money Huddle, a podcast that explores financial topics for families and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Planners Alliance. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Planners Alliance may maintain positions in securities discussed on the program.
Welcome back to the Money Huddle. My name is Michael Baker, and I'm here with my co-host, Ross Marinell. Ross, how you doing today,
Hey, buddy, I'm doing good. How you doing today?
Just trying to survive, man. Country boy trying to survive.
Listen, hey, at least we're both feeling well today.
Amen to that.
That is, these days, that's a good thing.
No question about it.
So listen, it's been a little while since you and I sat down.
I know we got some work to do.
Yeah, so we better get to it. So I came across this yesterday. Thought it was appropriate timing to just throw this out there. It said, this was a post yesterday from someone I follow on Twitter, Helen Meisler. She said, tomorrow, March 6th, is the 11th anniversary of the 2009 low in the S&P 500.
Oh, okay.
Kind of interesting.
Going on 11 years.
11 years. And so that figure, the S&P 500 back then was around 683. Just call
Isn't that crazy?
It is crazy.
683.
And so, of course, right now we're in the midst of some volatility.
Gyrations.
Gyrations is our
Louis Navalier would say. Gyrations.
Yes, he does bring the calming voice every day. So I thought that was interesting because, we have heard some comparisons when stock market volatility picks up. People start to make some flashbacks or just talking back to the 2008-2009 crisis, where we saw volatility really produce, some significant losses in the overall stock market. Certain sectors really, devastated with returns, negative returns, like banking and financials. Right. But I thought, let's talk just a little bit, big picture, some of the differences between 2009 and today.
Okay.
One of the things that stood out to me, because I just went back and did a little research, okay? March 2009, I'm looking at U.S. Bureau of Labor Statistics. Any idea what the jobs number was that month?
As in like jobs created?
Jobs created or lost.
In March 2009. Oh, man. I'm going to
go on the spot here.
I'm going to go with 95,000.
So that month lost 663,000 jobs. February 09 lost 651,000. January 09 lost 741,000.
Just hemorrhaging jobs.
I could just go back, and the reality is that we lost about over 8 million jobs during that couple year period. Sure. And today we got the news that the U.S. jobs for last month were
February,
so plus 279,000.
Right. It was greater than beat the expectation by 60,000, I think.
In 2010, the unemployment rate was 9.6%.
Across the board. In
2020, we're at 3.5% unemployment. So it doesn't mean that does not mean the stock market can't drop, but it's not the same. There's very different.
There are some changes. Yeah,
there's some big changes, and those jobs lost weren't all bankers. That hit everything because it was pretty much across the board. There was only a couple of sectors that were up.
Right.
Education, healthcare, but that hit contractors, so builders. Just think about all the people affected by a housing crisis. It really permeates the market. And just think it's interesting, it doesn't mean that we can sit here today with, the S&P 500 down about 8 or 9% on a year to date. And it doesn't mean that we can't go down further, but it's certainly a different time and era. And a lot of those statistics, especially employment, and I think just how many people have stronger employment than they had, let's say, 5 years ago, 8 years ago.
Right.
leading to, of course, consumer spending and other things that can benefit the economy. And it's just not the same. So it doesn't mean we can't have a drawdown or a stock market loss. It just means it's not. When people kind of compare it back to '09, let's not sugarcoat how bad some of it was.
Yeah, hopefully people are taking a more sober approach to what's going on right now with the market volatility. A lot of it's being driven by fears of this. We've had this black swan type event, the coronavirus that's come out of China, and there's been a lot of fear being driven by that. This isn't the same as, financial institutions, failing and systemic. Now, doesn't mean that things can't evolve and change, but we're also, I think, on a little bit different economic footing at this present time than we were back then. So to your point, people starting to compare the financial crisis to a rough couple of weeks is a little bit premature.
Yeah, and
very premature.
Too, one of the things that I hope everyone can appreciate about the stock market is it takes some pretty swift action.
Yeah.
The stock market doesn't sit on its heels and wait for things to happen.
No.
And there are certain industries and companies that have been more exposed to this coronavirus spreading and potential quarantine, and people just less likely to, let's say, hop on a cruise ship. Well, if you check out some of the cruise ship stocks, you'll notice they're getting hammered.
Of course.
I think Royal Caribbean was down around 50% already.
It's dropped significantly.
Significantly. You kind of think, well, what's the end in sight? And the market takes quick action. I looked at United Airlines. So obviously, if they're shutting down flights to certain parts of the world, airlines just economics aren't strong, right? In that area, you can't fly somewhere. United Airlines down 41.43% already this year. That's year-to-date numbers.
That's amazing.
So it comes fast, and it hits areas that the market believes or expects will be exposed to this in more ways than others.
Well, I think that's a great point because, when a lot of times when we specifically hear people talking about investing, or you go, or maybe even a better analogy would be when you turn on the television, they'll talk about market indexes like the S&P, NASDAQ, the Dow. They'll talk about these broad market indices. And that, first of all, doesn't necessarily reflect what an individual investor's portfolio might be looking like. But on the second level of that, we've talked all the time that there are stocks that are in those major market indexes that, even though the index might be up or doing well, that individual stock might be having its own bear market. I mean, something specific to the industry, regulation, or some challenges they might be facing as a company have forced them into a position like this where, you've got a stock like Costco or Kroger that is actually benefiting because people know they're going and cleaning the shelves out, so they're going to have blowout sales numbers, versus a Royal Caribbean, like no one's booking a cruise. You got two very different stories there, but yet they're both publicly traded companies.
Yeah, so Costco actually up year to date, coming off a 2019 of plus 45.7% return.
Yeah.
Up year to date 7.66, but if the market, broad markets are down and you're up in a position, that's pretty good.
Yeah.
I just think about areas too, like some consumer spending that is not necessary, right? So think about like Starbucks. Starbucks is having a little bit of trouble right now because maybe you don't want to go have a coffee that is where someone's touching your coffee cup, your coffee lid, and everything else if you're worried about it. And the challenge with some of those industries is, you may skip it, Monday and go back on Tuesday, but you're not going to buy 2 cups of coffee.
Well,
you just buy one, and so there's lost revenue in there.
And you have big cities, much more so than like areas where we live, but in big metropolitan areas, going in, let's go get a Starbucks. That's a social thing. You go to the coffee shop, you sit down, and you're in there, and it's packed with all these other people. And some of these larger areas, especially on the West Coast, people are likely avoiding a lot of those areas just as a precaution. And then, of course, China itself shut down like their stores.
They
shut them down.
I mean, a major quarantine in China.
Yeah.
I heard over 400 million people at one point were quarantined.
That's more than the population of the United States.
That's
insane.
Intense. That means a couple of things. One, it means that they felt like preventing the virus from spreading was the best way to stop it. Right. No, don't have necessarily a medical treatment, so the best thing to do is to stop the spread. So they locked 400 million people down.
Right.
In the United States, I was thinking about this too. Because something that that's been around. We've talked about this before. We have 58%. This is the statistic I came up with. This was from May of 2019. 58% of Americans have less than $1,000 in savings, so for emergency fund.
Yeah.
And, think about the impact of if we had to have a large-scale quarantine, what it means for folks to be out of the workforce for 1, 2, 3, 4, 5. What if you have to be out of the workforce for, a few weeks? If you don't have the emergency savings to withstand that, what do? You probably go to work. And that could be a challenge if the main preventive measure we have for this virus is quarantine.
Just everyone chill out for a couple weeks. Let this thing settle.
But if you don't have the emergency funds to withstand that, you don't have a lot of choice. And so it's just something to think about. I saw a great post. So there was a gentleman I follow on Twitter. His name is Mark Bovair. Do you follow him at all?
Yeah, Mark Bovair.
Okay.
Shout out to Mark.
Yeah. Shout out to Mark because he was responding to a post that said, financial planners often say you should have 3 to 6 months of living expenses in your savings account.
Yeah.
It just rolls off the tongue for us.
They talk about how hard it is to actually get there. I saw that tweet too.
I'll admit, that's kind of one of our first talking points when someone wants to start talking about investing, right? Is how is your
3 to 6 months?
You have that cash and kind of look at and they're kind of looking at you like, I just kind of want to invest. Everyone I know, but the emergency fund. So think about this. He said, if you wanted to create a 6-month emergency fund savings, well, you could save half your income for 1 year. How easy is that to do?
Right.
Near impossible.
I would say for a lot of people, yes.
Right. Save 25%
for
2 years.
The people that can most easily do it are the people that already make a very, very strong income.
And probably already have the emergency fund saved.
They're likely already pretty much there. It's the people that are, they're having to be diligent with how they spend their money, how they budget their resources, and work a budgeting plan that to say, you need to have 3 to 6 months of, living expenses put aside. That's a challenge.
The point he made, in which I agree with, is if you're having, if you do not have 3 to 6 months saved, the reality is it might take you 5 years to get there. That's saving 10% of your salary for 5 years.
Yeah.
And that's tough, but that's more the reality, I think, right? And so if something like this virus comes around and you're starting to think about will people be out of work for an extended period of time, that could become problematic for some folks.
Yeah. I think, I wrote about this in the newsletter that published this week. There are a couple things that I think, when you have an event like this, you have to be careful and measured with what you do and say, because you don't want to make light of it in that, there are some there's a serious nature to it. But you also don't want to overreact and pretend like the world is just coming to an end. And, one of the things that I talked about in the newsletter this past week was just trying to put some things in perspective. But what I'm hoping for truly is that when the dust settles on this and we kind of know the hand that we've been dealt globally, that what I think is going to happen, and I'm hoping is going to happen, there will be some conversations that get had about how, we're stacking our chips,
Yeah.
And, obviously the trade situation with China has highlighted, companies and having some of their supply chain, all their supply chain may be vulnerable to, what happens with China, and China decides as a country they need to shut the country down. That's their prerogative. But if you're a company that needs to get wedding dresses out of China, and all of a sudden you got brides that are planning to get married, and you say, your wedding dress is going to be 60 days delayed.
Hey, think about this. You could have a product that has 25 different components, and one of them comes from there.
Exactly.
And you can't get your product made.
And you think about, Apple's an easy one to target, but Apple's going to be fine, right? Apple's got more cash, than they know what to do with it. So they could have a hiccup. It's the other businesses that are needing that constant flow of goods and things happening. But the thing that startled me the most was an article that made reference to the amount of our medication that we source. I think it was like 85% of our antibiotics for sure, but like medicines in general, maybe even are being manufactured in China and shipped over here. And to me, like, if we want to have a talk about national security issues, you have a country that could, if they get mad at us and they say, okay, well, we're just not going to let the ships leave the harbor anymore. So no medicine for a country that has over 330 million people living in it. That is a tremendous vulnerability.
Right. So maybe to sum up feelings on the market, I saw a great quote from Howard Marks. So I'm scared to be in and I'm scared to be out.
Yeah.
Now you know you're investing in the stock market because we don't know what Monday's going to bring. Is Monday up 1,250 points and we have a 5% return, or are we going to keep selling off? I mean, that's kind of that moment, right? When you're really unsure what the next move is going to be. When now you know you're investing in the stock market.
That's right.
I came across one more thing I wanted to just put out there. We talked quite a bit about stocks and the stock market today, but something is happening in the bond market too.
Oh, is it?
Is it
now?
And so this got spread around quite a bit on multiple news sources this week, but the S&P 500 yield, which is around 1.92%, give or take, is now above 30-year treasuries.
That should be a bullish thing, right?
30-year treasuries are trading right now about 1.264 yield.
I checked it earlier today. It was 1.26, and the 10-year is like 0.70.
It's below. It's well below 1% right now. It's we're in uncharted waters on bond yields. Right here.
We've been telling people for several years now in our workshops, when we meet with people and we talk with people and have consultations here in the office. So this rate environment for fixed income is unlike what we've seen in the past, in that we've got equity valuations that are either arguably fair priced or overpriced, so high valuations in the stock market and low interest rates. And for folks that are trying to retire into this type of environment, it poses some challenges that need to be taken very seriously, because obviously a lot of historical references to investing, and talk about bonds as kind of a safe haven, or fixed income being your buffer against market volatility. Mm-hmm. But implied in all of that conversation is that you're actually getting some kind of yield on your fixed income. It's not just you own fixed income that yields, 1% or 1.5%. It's implied that you're getting a reasonable yield with your fixed income.
It could be at this point that you may have a high yield savings account. We talk a little bit about internet banking.
It's become an oxymoron. Oxymoron, high yield savings account.
But compared to the brick and mortar, locations that may be below 10 basis points in yield, even a bank like Ally or something like that, maybe at 1.5 or 1.7, and that's above the 30-year yield in treasuries. That's really startling. I think people forget. I did a little look back, right? So I kind of grabbed a few dates in March. So March 1990, 30-year treasury yields at 8.639%.
Wow.
March 2010, so right after the sort of
financial crisis.
Yield, 30-year yield, I have around 4.71, somewhere in that range.
And that's when knowing that they had basically cut the federal funds rate to zero.
Yeah, so Fed had already taken some substantial action.
Exactly, and you still had a 4% or so yield on the 30-year.
And today we trickled down to 1.26%.
Yeah.
As our listeners know, There's an inverse relationship between bond prices and yields. I mean, talk about it just a little bit, just 2-minute conversation on why this is important long term.
Well, I think, one is you have to consider how many people are still being told to protect their retirement with, the use of fixed income. The implication is that the bonds are going to have a buffer or safety against, equity volatility, and you're going to be getting some yield, like I said. But bonds are not considered, quote unquote, a safe asset class. And we talk about this a lot when we talk to people about the language of risk, right? That Wall Street and investment professionals talk about risk very differently than your everyday investor and people on the street. Investment professionals talk about risk in terms of like variance and standard deviation and the amount of volatility or how much movement you might see inside of a portfolio in a given period of time. But everyday investors thinking like, all right, am I going to lose all my money if I invest in this thing? Like, what's my worst case scenario? Could I be down 40% next year? Because they're looking at like the real paper loss, how much of my capital goes away. And so when you get into bonds, investment professionals are often guilty of talking about bonds as being a safer or low risk asset class because there's not a lot of volatility.
Right.
But when you have interest rate movement, where interest rates can spike and go up, well, that tends to push the prices of existing bonds down. So yields might be going up, but the price of what you're owning is likely going down. The opposite's also true. If we start to see yields fall, it can buffer and push prices up. But then the challenge is well, if we're at 0.0 nothing from in an interest rate environment, where do they have to go? I mean, they've
if
said
interest rates go up in the future, that means existing bondholders could see their value decline.
So a lot of people that are rushing to safety right now, to bonds, if the interest rate environment, and I hate to say this phrase, but if it starts to quote normalize or rates just tend to start rising again, which I feel like they got to go up, at some point. It doesn't mean it's going to happen overnight, but they've got to start rising again.
Hey, unless the new normal becomes negative.
And I have to say, another point that we've talked about in so many of our workshops is negative interest rate environment around the world where, other countries have either negative nominal yields or the real inflation adjusted yield on their sovereign debt is negative. And the U.S. has been one that has, been barely over.
Right.
And now here we are where if you use just a 2%, placeholder for inflation, right? CPI 2%, 2.5%. We are now technically in negative real yield territory, which is, it's not great. It's not great for, the market itself, but it poses some unique risk to savers for retirement.
One of the bright sides is it makes certain debts less expensive. So mortgage rates have been falling, and
this is your time right now, folks. If you are, and this is, so I always like to try to look at positives. So this is your time if you are thinking about doing a refi on your home, and you've got, we can't speak about credit, but I mean, if your credit is good or you feel like your credit's workable, where you can look at doing a refi right now, go shopping. Go and shop the rates because you might be able to move from a 30-year to a 20-year or a 15, or down to a 15 and see a very small flutter in your payment, but you will can potentially save thousands over the life of a loan just by changing your amortization schedule.
Yeah, and you might find 10 and 15-year rates in the twos now.
Yes,
which is just mind-boggling to me.
It is. And so, I mean, one of the things is, this is something to be considered. And so, like, I'll use my personal example. I'll talk about my life for a second so I know I won't get in trouble by anybody listening, right? So Elizabeth's my wife, we took some cash out of our home last fall because we wanted to do some projects. Our intention is like we're going to put some money back into the property, which we didn't have a problem taking cash out because we're going to try to invest it in the property and raise the value of the property. And when you do that, usually you get a little bit higher rate of on your mortgage because of you're taking money out. So my intention was all along to go ahead and I'd wait a little bit of time and I'd just refinance again and get a lower rate. Well, now rates have dropped so far that right now, I mean, I'm looking at a 3.375 interest rate on a 30-year fixed.
I know.
It's insane. And so for the young people, what I would say to young people, when you talk, a lot of times investment people will talk about this is a generational buying opportunity in the market. So like if this could be a generational housing opportunity for you to potentially pursue a mortgage or get a mortgage where you are paying super low interest rates. And you need to look at this, and I mean, because it's always sexy to talk about investing, but sometimes good financial moves is just saying, hey, look, I can refinance, open up some cash flow, and then what does that additional cash flow do? And so, to my own case, in just not even 12 months, we're now refinancing lower interest rate, but it might cut $200 a month off of my mortgage payment.
Right.
And I've done nothing but just exist. I haven't done anything special. Just this is
Michael, you're special to me.
But I say that's the rate environment that we're in right now.
All right, so I'm going to throw, since you were positive then, I'm going to
Sure.
come take another look back. And this is kind of what makes, I think, people a little frustrated. Because we're staring at the lowest interest rates we've seen in treasuries, and that does transfer over into mortgage rates.
Right.
And I just pulled up from creditcards.com, March 2020, average APR and new credit card offers still 17.25.
Oh, they're getting them.
It's just really, it's so dislocated from what it costs to borrow in other areas. And really quickly, I mean, I looked at, I've always talked about student loan rates, and a direct student loan is now 4.53%. It just,
Right.
You could look at a 10-year mortgage at 2.5 or 2.625 and compare that to a 10-year direct student loan at 4.53. It just gets under people's skin. You know what the plus loan is? The parent loan, 7.08%.
Oh,
That's the loan that parents borrow to help their children pay for college.
Yeah.
And that's the loan that you can borrow the most because you can go to the full cost of attendance.
Right.
And it's 7.08%. And it's eye-popping.
So the credit card thing, I do understand why the rates are higher. First of all, it's it's insecure, it's unsecured debt. I mean, they're not going to come, take your car away if you don't pay your credit card payment. Now that you might get, some threatening phone calls and things like that, but in no way we're suggesting not paying credit cards. But obviously they have to charge a higher rate for a few different reasons, but some of these credit card rates are outrageous, eye-popping, and the spread on what they are versus like real debt like mortgages and car loans and things like that is a bit mind-numbing to look at how big that gap is. I
agree. So anything else you had? Did you have anything else you want to chat about today?
Well, I know you probably saw it, and we'll timestamp this podcast because of what we're talking about. But there was a tweet that there was a story that aired on MSNBC, and it was these two people talking about Mike Bloomberg.
Man, where's Andrew Yang in math when you need math? Go ahead and tell
they were talking about how much money Mike Bloomberg spent. I've heard 500 million, I've heard 600 million, and they're sitting there yucking it up, and they're like, oh, he could have just given every American $1 million and called it.
All right. So in their defense, there was a tweet that said, he could have given every American $327 million of his, $1 million, and they just kind of rolled with it.
They did, and to that point, what I thought was more hilarious is leave it to financial Twitter, because they're all like, okay, first of all, how does a math error this bad make it on air? But on top of that, they're like, the producer of the segment, it got past the producer, the graphics person that looked at the tweet, it got past the graphics person, it got past the host, and then it's like all these layers of people like that should have caught that and said, we can't say that on air. It didn't. And so, and I say that because what I was telling someone today, I said, this is the same news media that's trying to convince you right now that they know what they're talking about when it comes to the coronavirus. It's God. You just gotta understand that it's, unfortunately, it's like, so our news has become entertainment as much as it's come anything else.
We could end on this. Whatever your experience was over the last couple of weeks in the stock market, it probably pales in comparison to Mike Bloomberg spending $500 million on his presidential election to exit in the way and in the manner that he did. So
he paid $500 million to basically be publicly humiliated in two debates. That's pretty bad. But I think that there are still to kind of button this up for us. I think that there are going to be some lessons. Number one, I'm optimistic on this. I really am. I think people are going to see a stark difference between countries like the United States that have top-notch healthcare systems. It does have flaws. I'm not saying it's a flawless system, but we have top-notch medical professionals here in this country, top-notch medical technology, and you're just going to see a different type of outcome than you see in some of these countries like China that, they're have a different governmental system that are a little bit different in how they do things. I think it's going to hopefully give the medical professionals in our country their time to shine. And I hope that they get the praise, once the dust settles, I hope they get the praise that is due to them. And I hope we all learn from this. Like, there will be lessons to be taken away.
Sure.
And then, number two, I think that this could have some positive global economic impacts. I mean, I think there's going to be technologies. People are going to have to use some technologies they necessarily have not fully integrated into their business so they can continue to operate. They're going to have to reevaluate supply chains and like what countries they do business in. And it's like anything else, anytime there's a crisis, it forces reflection. Like how can we prevent this from ever happening again? And so I want to be optimistic and say, look, this isn't comfortable right now. No one likes watching the market do what it's doing, but this is also a time when the tree gets shaken, and a lot of people that were just playing fast and loose and not respecting the game, they understand now. Like, hey, it's not always sunshine and rainbows, right. And so that's what I'm hoping for. And if anyone's got concerns or they need to want to talk to, we encourage you to reach out to your financial professional. Don't be afraid to call and ask questions. That's what we're here for. And if they don't want to talk to you, then we'll talk to you. You can call our office. We'd be glad to talk to you.
We'll talk.
Yeah, absolutely. So, as always, thank you for listening. We appreciate everyone that listens to the show and comments on Facebook or sends us a note and tells us they like the show. That encouragement is always great to hear. If you got anything you'd like us to talk about in a future episode of the Money Huddle, drop us a line. You can find us on Facebook. We have a Facebook page. You can email us at themoneyhuddle@vcplanning.com. And as always, thank you for listening. We'll talk to you next time.